Welcome to the Accounting X Podcast. Practical content each week to help you and your finance and accounting teams succeed in the digital world. Episode 3, Challenges when producing financial consolidations. One of the accounting challenges that many businesses face arises when they need to produce a single set of financial statements to consolidate the information from across multiple companies in a group. In today's episode, we explore why these challenges arise, the implications of getting the approach wrong, and the steps companies can take together to both remove the risk and improve confidence in the numbers. Our guest for this week is Mark Richardson. Mark is co-founder and CEO of Mondial. A qualified accountant for over 35 years, he has also spent over 30 years providing leadership and direction for leading players in the ERP space including SAP, Sage, Epicor, Avalara, and Plex systems. Mark is a specialist in product positioning, messaging and launch management, and has become an established thought leader in the global accounting and financial reporting software sector.
My first question is, perhaps we can start at the beginning. Mark, could you tell me, why do companies need to perform consolidations at all, and what use do they provide?
Yes, well, as companies grow, they often find themselves having multiple legal entities through which they do business. Sometimes this is deliberate to separate business units that offer different types of products and services. On other occasions, companies may do business in different countries and find they have a need to separate entities through which to transact locally. And on other occasions, the group may have merged with or acquired other companies and find itself left with multiple legal entities that way. Howsoever the situation occurs, the company will periodically need to consolidate the data from these different entities into a set of financial statements. These statements provide the management of the company with information needed to run the business. They also offer other stakeholders, such as investors or banks, a view of the overall business progress. And they help the company meet its legal obligation to provide accurate statements to regulatory authorities. Now, while we tend to think of consolidation as a single function, in larger organizations, consolidation can actually take place at multiple levels within a business. There may be, for example, a consolidation of entities in the same geography to give a regionally consolidated view. Or there may be the need to consolidate business units that are in the same vertical markets to give a view by industry sector, and so on. So we can say that consolidations are useful in that they are required to run the business effectively, but they're also mandatory as they're something that the company must do and must get right.
So I'm quite curious, why does the process itself sometimes present a challenge, and what are the implications of that?
Yeah, the actual process of consolidating information into a single set of financial statements begins by adding up all of the information in each of the source companies and presenting it in the way that makes sense. For example, all of the assets in each company will be grouped together, then all of the liabilities, the equities, the revenues, the costs, and so on. And once grouped together, they will also likely be subcategorized and then presented in a single financial statement. This is where difficulty arises to begin with. The companies in the group may not maintain charts of accounts that categorize all of the accounting data in the same way. Even if companies use the same accounting or ERP system, it's very likely that somewhere along the line the account numbering systems will get out of sync. Where companies have been acquired and use different ERP systems, it is likely that there'll be no correlation between the numbering systems at all. This means that to successfully consolidate the data, an intricate mapping system needs to evolve, which points the right accounts from each system to the appropriate place in the report for the data to make sense. Now, as you might imagine, this can be a really painful exercise. It's often undertaken in spreadsheets, which in itself offers enormous scope for errors. But even if the spreadsheets are well constructed, simple changes like adding new accounts to the source system, which don't automatically flow through to the mapping spreadsheet, can mean the figures suddenly don't balance, and accountants spend hours trying to track down discrepancies. To make matters worse, the spreadsheet data which is used in the reports, provides no context. Because the process is so convoluted, most consolidations use only periodic balance information from the underlying system. This means that when management looks at the consolidated results, even if they're technically correct, there is no way to drill into the reported figures to investigate the makeup of any of the individual balances. So what you find is that management often can't make decisions with any confidence. They can't really explain the numbers with certainty to the external stakeholders, and there can be real implications if subsequently the company has been found to have reported incorrect numbers to the regulatory authorities.
Well, I don't know, but it sounds like, instead of making it easier, consolidations can actually be a real mess. I mean, it wastes time, generates real risk for the business, and could potentially cost the company lots of money. What do you think can be done about it?
Well, a lot of ERP and accounting software companies have spent a lot of time and effort on making their financial reporting a lot better. Unfortunately, many of them are still only able to produce rudimentary consolidations, and even then, only when every company in the group uses the same ERP system, has identical calendar period structures, and have an identical chart of account structure for accurate mapping. Now, fortunately, a new breed of financial reporting software vendors are now appearing that can use cloud technology to solve the problem of consolidations once and for all, for even the most complex of organizations. Firstly, these solutions import the actual transaction data from each subsidiary company, meaning that any reported balance on any report at any level of consolidated roll-up can be investigated by simply drilling down to view the detailed transactions that make up the balance. This provides greater confidence to management that they can rely on the reported figures. Next, the software allows a central chart of accounts to be created, to which all contributing charts of account can be mapped and then automatically updated in the future. This means that however different the various charts of accounts are across the group, and however frequently they change, they can all be mapped and updated to the same corporate standard, which is the one then used to build the consolidated reports the company needs. So the data is always complete and correct, and no anomalies should occur.
Well, it sounds like these reporting solutions are great for bringing the data together, but can they help in any other ways?
Well, it's important to understand that these new solutions are not just report writers, they're pseudo-accounting systems themselves. So in addition to having their own charts of accounts, they have their own financial calendars, meaning that even if the source companies have got different financial year ends or operating calendar structures which are different, the reporting software can normalize the data and consolidate the data correctly and accurately. But it goes further. One of the challenges that many companies face when doing consolidations is when the operating companies do business with each other, and these intercompany transactions need to be excluded from the consolidated figures. Most existing accounting systems find this really hard to do, but the new generation of cloud solutions can either filter out the appropriate transactions held in the underlying systems, or can even make auditable journal adjustments to help get the figures right for each entity. And where companies operate in different jurisdictions, particularly where accounting standards are not the same, the ability of these systems to undertake accurate transactional level revaluations or post-GAAP specific adjustments that affect reports to one jurisdiction but not the other provide the most flexibility of all.
Mark, the benefits sound great, but does introducing a new reporting system create risk for the company?
Think of it this way. You may have invested sometimes millions of dollars in your various ERP systems. They work great for the different operations you have in your group, particularly the customer-facing ones. To change them just to improve financial reporting would be a massive undertaking, and it's this approach that presents huge risk to the company. Yet accurate financial reporting is a critical function within an organization. If you get it wrong, it can have serious implications for the company at many levels. It seems really astonishing that given its importance, so many accountants have been forced to rely on cobbled together spreadsheets and macros for the last few decades. The advantage of using a system that can automate the consolidation of all transaction data from all of your systems worldwide seems too good to be true. But it's the cloud that allows this type of technology to exist. It would seem to me that the bigger risk to any business comes from not using this type of technology now that it's finally available.
Consolidation of financial statements is a process where multiple companies within a group are consolidated into a single set of financial statements. This process can present challenges as the different companies may not maintain data in the same way, and mapping systems need to be created to match the accounts from each system to the appropriate place in the report. Incorrect consolidations can lead to errors and lack of confidence in the numbers, so it is important that companies take steps to remove the risk and improve confidence in the numbers. Thanks for tuning in to this week's episode of the Accounting X Podcast. Don't forget to join us next week for another episode. This podcast has been brought to you by our sponsor. Check us out at mondialsoftware.com.